ATT Personal Tax, May 2014, question 11, and this question has been adapted for the 2021 tax year. My name is Omar Aswat. In May 2017, Diane, an additional rate taxpayer, subscribed for EIS shares in Lockhart Limited and claimed EIS income tax relief. Lockhart Limited has not been successful, and on 11th of June 2020, Diane sold her shares, realizing a capital loss. So we have a few things here from the question. An additional rate taxpayer, she subscribed for EIS shares in May 17, disposed June 2020, and these shares have realized a capital loss. Explain the ways in which Diane could relieve this loss and identify which is likely to be the most tax efficient, and this is for 3 marks. Now, what is being tested here is the positive tax advantages of EIS shares, which are present to incentivize investors. So, just a bit of background, but if these shares were sold at a gain, obviously they are sold at a loss here, but if the EIS shares were sold at a gain, the capital gain would be exempt from CGT. Why? Because to qualify for the CGT exemption, the disposal must not be within 3 years. Disposal not be within 3 years. And as you can see, subscription was in May 17, May 18, 19, 20, disposed June 2020, so it's just past 3 years. And income tax relief must have been obtained on subscription, which is also the case from the question. So in this scenario, any gain would have been exempt. Now, this is unusual in CGT because where normally gains are exempt and not chargeable, the losses would not be allowable. However, the mismatch for EIS shares is further encouragement to investors. So what it is that although the gain would have been exempt, the loss will still be allowable. The gain exemption is covered in TCGA 1992, Section 150, TCGA 1992. Now, this question is actually asking how the loss can be relieved, and usually capital losses can only be set against chargeable gains. So one way that the loss can be relieved is offset against any gains arising in 2021, and that would relieve tax at 20 or 28%, as Diane is an additional rate taxpayer. Or you can carry forward the loss against future gains. And this will also be a tax saving, a potential tax saving at 20 or 28%, depending on whether it is a residential property or not. Now, there is a very special generous relief, and the only time this relief is available, which is called the share loss relief, again to incentivize investors to participate under the EIS scheme. And if the shares meet certain conditions, the taxpayer can choose whether to set the loss against income of the same tax year, income of the previous tax year, or both years. And given the lower rates of CGT compared to income tax, it is most definitely more tax effective to set the losses against income if possible. So, share loss relief, very beneficial for investors. Loss can be offset against income of income of the same tax year or previous or both. A bit of additional information is that if the claim is to settle loss against total income for both tax years, the claim must specify the year for which the deduction is to be made first. And the claim for relief is an all or nothing claim. So a taxpayer cannot make a partial claim in order to preserve the personal allowance. Share loss relief is covered in detail under Section 131 ITA 2007. So the question says, explain the ways in which Diane could relieve this loss. So we can say offset against gains arising in the same tax year, carry forward the capital loss against future gains, or the most beneficial, which is part of the question, identify which is likely to be the most tax efficient, would be under Section 131, the loss to be offset against income of the current tax year or the previous tax year or both. And that would give you 1 mark for each point. 3 marks.